Hello, everybody. This is Brian Terry with the Conservative Options Trading Group, and I wanted to share with you a trade I did recently on XBI. I show it as a leap trade. It's actually a diagonal call trade, but it's a strategy we have started doing over the last few months in our trading group with pretty good results. So again, the trade was on XBI, but first, just want to go over kind of the basics of the strategy. First part was it's a diagonal or calendar call spread, and the only difference is it's a diagonal if the strikes are different. A calendar, the strikes are the same. So we begin by buying a further dated option, usually go out about 90 days, and then I will sell the nearer dated option. And generally, I sell weekly calls. So again, I'm looking for a strike somewhere in the range of 40 to 50 delta. And a lot of times it really just comes down to where's the open interest. And I like to go out 90 days. And then I will sell weekly calls against it. And I generally sell the weekly calls above a resistance level or in that 15 to 20 delta range. And it really functions a lot as a leveraged covered call, meaning that when we buy the long call, that's equivalent to buying shares, and selling calls against them is kind of the second piece of our covered calls. So again, this can actually be both a bullish or a bearish trade. If you want to set it up as buying the put and selling puts against it, you can do it that way. I'm just going to talk about the bullish trade right now, and again, the delta is really based on what's the cost of the trade, and I'm looking at that 40 to 50 range, and whatever delta you choose, that's kind of an approximation of the number of shares you control. And also what I found is if you go to a lower delta, the lower delta you go, the higher your buying power reduction is. So just check with your broker or play around with it to see how that works on your platform. And the short strike, again, we collect credit by selling them, and it reduces the basis or the cost in our long call, but it also caps the maximum gain in the trade. So if we had just bought the call and it went up, 50%, we'd have made a lot more than if we sold the call, but it's a covered call, so same kind of principle applies. Here's the actual trade alert that I sent out on January 6th on XBI. The ETF was trading at 83.33. I sold I bought the March 83 call. It was a 50 delta and paid $582. So it cost me $582 per contract and I was actually controlling 50 shares. If I had bought 100 shares, it would have cost me $8,300. I sold the March 13th 88 call, collected 42 cents. So the basis in the trade was $5.40. So you just simply take the 582 less the 42 cents credit, and that's your basis to start with. Here's a copy of the chart and I put the trade on right about here, January 6th, and you can see it went sideways for a few days and then had a couple of really big days. So the trade definitely moved in the direction we were hoping. So on January 6th, I opened the trade and I paid a net debit of $5.40. So the ETF went higher. I exited the trade on Thursday before expiration for a net credit of $7. Now this would have been selling the long call and also buying back the short call. And so the return on risk was 29.6% in 6 days. And had that trade not moved up quite as much, what I would have done would have been to continue to sell weekly calls against the long calls and further reduce the basis in that stock. So in terms of a summary, I think this is a great strategy. I like to refer to it as a leveraged covered calls because instead of paying $8,300, we're doing it for less than $600. The cost of the trade is dramatically reduced, and our risk is really reduced too. So if you had bought the 8,000, 100 shares for $8,000 and it went down 10%, you would have lost $800. This is your max risk is what you paid for the long call. So it's a defined risk trade, and we can reduce that basis, pretty close to zero if we're aggressive and we're writing calls against it. I'm shooting for like a 30 to 50% return on risk on winning trades, and by selling the calls again, we can reduce the basis pretty much close to zero. I had since I started this strategy in December, we've had 8 out of 9 have been winners. The one loser was in Apple, and I actually paid like $5.50 for the call and had it written down to 68 cents when the trade expired. So that's kind of if the trade doesn't work, you can really reduce your cost by writing those calls. So anyway, I just wanted to share that with you. It's a strategy that I'll probably be doing both on a bullish and bearish basis this year. If you want to check out our trading group, our website is right there, conservativecoveredcalls.com. It's a great little trading community. We do in-the-money covered calls, put spreads, and now these leveraged covered calls. If you have any questions or comments, please go ahead and post them in the feedback section. We'd love to hear from you. And if you want to send me an email, I can be reached at conservativecalls@gmail.com. Thank you so much. It's been a pleasure. I'm going to stop the recording.